Hello everybody. Firstly, I'd just like to welcome you to this webinar where we'll be talking about the OPEC meeting and potential opportunities to trade crude. My name is Sasha and I'm a financial analyst from the research department at Fortrade. I'm delighted to have you with us. If you have any questions, please call us and ask to speak to a senior account manager who'll be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. And now let me explain what a market opportunity is if you don't know. A market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple-to-understand opportunity to trade in the markets. We will select an instrument such as gold or a currency pair and tell you our very best estimate on its price direction so that you can trade on it if you want to. Market opportunities are produced by the research department on a daily basis according to market conditions. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and support and resistance levels. It's important to understand it's your decision whether you want to trade on market opportunities or not. Here's an example of a market opportunity. Here you can see fundamental analysis on what's going on with crude oil. You can see, for example, how Saudi Arabia says it will make up the shortfall of oil in the market due to Iranian sanctions. This could apply downward pressure to crude prices. So, as you can see, this is a downtrend opportunity over a weekly period. When using a market opportunity, it's vital to look at the pivot point on which the calculations are based. In this instance, if the price reaches the pivot point, the current price that you can see in the center of the screen here, this shows the right moment in our estimation for opening a trading position, had you decided to trade on this market opportunity when it was active. You can see below the trend direction and the time period. It's important to know that you know how to use the stop loss and take profit options. You have support and resistance levels further down. At these points you can put a stop loss and take profit, and further down you have calculations. If you close the position using take profit, you can expect these kinds of profits at those support levels in green. If the price is going against you, you can potentially have a loss of this amount at the resistance levels in red. Finally, profit and loss calculations are based on a one-lot trading volume. So, OPEC and this meeting. Traders know it's important to understand the role of the Organization of Petroleum Exporting Countries, which includes many of the largest oil producers in the world, including Saudi Arabia, OPEC's key player. The organization generates some 44% of all world oil production. It agrees jointly whether to increase the production of oil, which should influence prices down, or to restrict oil production, which should help push prices up. Since 2016, the organization has successfully invited Russia, the second highest producer of crude, to join these agreements, even if Russia isn't formally part of OPEC. OPEC and Russia previously had an agreement to restrict the supply of crude oil. The original meeting date for this OPEC meeting was scheduled in April, but this was postponed due to the desire for more market data. This turned out to be a very good decision, considering that oil prices have fallen sharply since then. But the meeting was again postponed to the current date of July the 1st to July the 2nd, after disagreements among member states, particularly between Iran, subject to US sanctions, and Saudi Arabia. OPEC member states were also resentful at what they saw as Russia and Saudi Arabia wanting to have the meeting after the G20 meeting in Japan, suspecting that the OPEC meeting would just rubber stamp what had already been agreed by the larger powers at G20. At the last full meeting in December, in the face of declining oil prices, OPEC decided it would further cut production by 1.2 million barrels, which eventually caused a stabilization and a slight bounce back in crude oil prices. The point is that Russia, the world number 2's producer, and OPEC have considerable power to influence oil prices if they decide to use it. Saudi Arabia has tried to work behind the scenes with other OPEC members to get Russia to agree to a more formal deal to be signed between Russia and OPEC in order to more effectively control production. Russia has resisted these moves so far. It's also clear to most analysts that Russia doesn't mind lower oil prices as much as Saudi Arabia, which would prefer that crude prices rise sharply. But let's look at crude's price direction over the last 9 months or so. As you can see on this chart, crude oil last year hit a peak in October of $75 per barrel. That's marked by the green line. Trade war fears and surging production put a stop to that as crude sank in December to below $45 per barrel. Once OPEC agreed in December to renew their expiring production limitation deal, oil prices recovered and re-entered an uptrend that lasted until late April this year. But we can see by the magenta line that prices have gone down by some 16% since then. The reasons for crude oil's recent downtrend broadly concern the same issues. Trade talks between the US and China broke down. Economic indicators show that global growth is slowing down. We have seen both OPEC and the respected International Energy Agency in their oil reports state that they expect future oil demand to gradually slow. On the supply side, we have the US continuing to pump out record levels of oil, and President Trump demanding that OPEC countries let oil prices fall. So the most recent factors affecting oil prices, as you can see on the screen here. In recent months, there have also been geopolitical factors affecting crude prices, including in Venezuela and Libya, with a military conflict on the ground, which has helped support prices. Most recently, we have seen sharp price increases following attacks on oil tankers in the Gulf of Oman, and the shooting down of a patrolling US drone by Iran in the Middle East. While these are important factors, their effect is more often short-lived once baked into the price. Investors will now be looking to OPEC to decide their next moves on the oil markets. So the million-dollar question is whether OPEC will decide to prolong the existing agreement of withholding 1.2 million barrels per day of production. Saudi Arabia, the United Arab Emirates, and Iraq, considered the senior members of OPEC, are strongly in favor of extending oil output cuts until the end of the year. As usual, Russia has been more cautious, but it's expected that the country will be happy to extend the current agreement. In the event of no agreement, the prospect of crude going down below $50 per barrel is a realistic one, and this would cause a budget deficit in Russia. Most traders believe that OPEC will agree to an extension, and this would provide support to crude prices, with bulls hoping it would be enough to reverse the recent downtrend. An unlikely surprise new agreement to cut more than 1.2 million barrels per day would almost certainly send oil prices higher, while no agreement could send crude back down to December's lows of just $42 per barrel. Of course, we at Fortrade will be following any developments that affect crude oil prices very closely. So please do get in touch with a senior account manager if you have any questions or want to take advantage of the trading opportunities that this OPEC event will present. Until then, goodbye, and please join us again at Fortrade soon.